Verizon is the largest cellular network company. Is it worth having Verizon in your portfolio? If you want to hear more about it, stay tuned. Hey everybody, Kevin Burgess back again with yet another video. I think you're going to like this one. This one has to do with Verizon. Verizon is the largest cellular network company, and it plays an important role in my portfolio, so I wanted to take a deep dive into it to make sure that I understood the company and its strategy and make sure that it did fit into my portfolio. So if you're new to the channel, what we're about is dividend growth investing. So we look at dividend stocks. One of the goals that I have for this channel is to inspire people to invest and grow their portfolios. Once a week, I will share my portfolio, which is coming up here in a few days. And also, in between that, I will do some deep dives into certain stocks. Today is about Verizon, and you're not going to want to miss this. If you like dividend stock investing, consider subscribing to the channel. It would mean the world to me, and I would really appreciate it. If you like this video, particularly on Verizon, give it a thumbs up so that others will know that it's got quality content in it. And without further ado, let's get started. So Verizon Communications was created in June of 2000 by the merger of Bell Atlantic Corp and GTE Corp. And it's one of the largest mergers in U.S. business history. With the acquisition of Alltel Corp in early 2009, Verizon Wireless became the largest wireless service provider in the U.S. as measured by the total number of customers. With the acquisition of AOL completed in June of 2015, Verizon began the next chapter in the company's history with the intentions of becoming the #1 global media technology company for creators, advertisers, and consumers on a mobile-first network platform. However, this strategy was reversed with the sale of Verizon Media in 2021. The industry and competition, there's several wireless telephone services out there, but really only two competitors. I mean, if you think of the U.S. market, Verizon holds about 40% of the market in the U.S., AT&T about 30%. I think T-Mobile is somewhere around 18%. So that gets you about 88% of the market is held by these three companies, which is Verizon, AT&T, and T-Mobile. You can see that Verizon is the largest of these three in both market cap and enterprise value. And surprisingly, though, AT&T has a lot more employees, almost double the employees that Verizon has. And it might have to do with the media business that AT&T still holds at this point. Verizon has three segments. They have a consumer group, a business group, and then a corporate other. You can see that their consumer group is by far the largest, and they provide customer-focused wireless and wireline communication services and products direct to consumers. The business group provides a lot of services related to a business, and you can read those on the slide. And then the corporate and other, the financial reporting piece that I'm showing here is from 2021. So it does have the media business inside corporate and other that will go away in 2022 because it was sold actually in 2021. Strategy and approach. I thought it'd be interesting to talk about their strategy and their approach. They, similar to AT&T, have sought growth in areas other than the cellular network business. They have both gone into a quest for growth through media. And so they've acquired all these media assets, and both of them have determined that that was not a very good decision. So Verizon came to that conclusion earlier than AT&T did, and Hans Vestberg came in as CEO in 2018 and became chairman of the board in March of 2019. But Hans Vestberg came in and actually changed the strategy of Verizon. He changed it from seeking growth through means outside of the cellular network to seeking growth within the cellular network. And you can see that the purpose has become, we create the networks that move the world forward. In terms of pillars, they're looking to preserve their legacy advantages, strengthen core assets to maintain market leadership, and transform operations to drive change. So on the right-hand side of this slide, you see that the focus of everything that they do is best-in-class networks. You can see the things that they are driving toward, and all of that is focused on being the best-in-class network. And then you'll notice in May of 2021, the news article headline that said Verizon Media to be acquired by Apollo Funds. So Verizon has sold their media assets, which AT&T is in the process of doing as we speak. Hans Vestberg was on Mad Money and basically said that 2021 was a transformative year. Many of you will recall that 5G was anticipated to possibly interfere with airline traffic communications. So while that's still going on, what Vestberg said is that he believes that is nearly resolved and that he is very comfortable that will be resolved. They have 95 million people covered by C-band, which is the 5G. And then they have, and according to this interview, he said there are 7 different vectors of growth. However, I could only find documented that there are 5. There may be some that he's kind of adding to that, but they believe that, the point of that is they believe that there are vectors of growth within the network business itself. And so they're not looking to seek outside for growing the company. So these are the 5 vectors of growth that they're looking at. This is an article from Forbes. You'll see that Verizon, at least at this point in time, looks like it was in 2020, has a superior network, lowest customer churn, long-term demand for their mobile data, and superior profitability to their peers. Verizon is also widely recognized as the best-in-class provider. So in terms of competitive advantages, it seems like that is one of the competitive advantages, that they have product quality, also customer service since they have the lowest customer churn, and then economies of scale. It's pretty difficult to get into this market, especially with 5G, when Verizon spent around $46 billion to acquire licenses. They spent the most of any of the 3 carriers in acquiring 5G licenses. So economies of scale is a pretty big competitive advantage for them. In terms of risks, there are many, as many companies have. They have competition. They have AT&T and T-Mobile, who are competitors. They have litigation through the 5G and airlines issues, as well as others. They have operational risks related to cyber, as well as technological innovation. And regulation is a risk for them, as well as their debt. They have increased their debt in the past year. So it's important for us to consider that to be a financial risk. In terms of capital allocation, they have, as you can see on the slide here, they have grown their dividend very slowly over the last 20 years, over the last 5 years, and even over the last 1 year. Last 5 years and last 1 year, both are at 2%, while in the last 20 years, it's a whopping 3%. So they are a very slow dividend grower, but they have grown their dividend for each of the last 15 years. So I think that's important to point out, is while the growth is slow, it is consistent. So they are a dividend grower. This would put them as a dividend contender. And their current yield is a nice 4.82%. Shares outstanding, according to their 2020 10K, they ended the year 2020 and 2019 without repurchasing any shares of common stock. I don't expect that to change in 2021. I think it's important for them to recoup those costs for the licenses for 5G and reduce their debt. So I'm not expecting that they will increase their dividends significantly, nor am I anticipating any significant share repurchases. Financial metrics, you can see that their sales have grown some over the last 10 years, Not significantly, but they have grown to some extent. Their earnings per share, however, have risen pretty nicely. They're in the, maybe doubled their earnings per share. However, their free cash flow has decreased actually and is negative in this last year, driven, I think, mainly by those 5G license acquisition costs. The earnings payout ratio, however, is a nice 47%. That's a very comfortable spot for an earnings payout ratio to be in. The free cash flow ratio does not really matter here because with a negative free cash flow, it's always going to be a difficult measure. Their dividend safety rating, according to Simply Safe Dividends, is 87 out of 100. So that's pretty safe dividend. And they have a BBB plus S&P credit rating. One of the things I want to point out here is that their net debt to capital is 68%. And you'll notice here that the interest coverage, though, is 9.31. And that's actually a nice interest coverage ratio. And it's part of what leads to the Simply Safe dividend rating of an 87 is that their interest charges are well covered. In terms of valuation, Morningstar has them valued at $59. They're currently around $53. That's about a 10% discount according to them. Their return on invested capital is 11%, which is above their cost of capital. So they are returning value to shareholders on a consistent basis. In terms of valuation from Fast Graphs, you'll see that they are well undervalued. According to this chart, you'll notice that the black line is the price, where the blue line is where they typically will trade at, a PE ratio that they will typically trade at. So you'll see that for at least the last 6 years or so, they hovered right around that blue line, and now they are well below that blue line. Their price target, according to Seeking Alpha, they have a price target, average analyst price target of $59.24, a low being 45 and a high being 71. So with a current price of 53, a valuation of 59, and a price target of 59, I don't see any issues with Verizon in terms of a pricing model. So in summary, what do we see? We see that Verizon has a pretty good financial model. They have, in the past year, however, spent a lot of capital, especially for these 5G licenses, which means they've incurred a lot of debt. So they have a good strategy. It's a focused strategy. They have a good financial balance sheet. However, they have spent a lot of money in the last year. So that's important to keep in mind. So with all of that being said, what am I going to do with Verizon? So let me just give you a little background. Verizon is a key stock in my dividend yield portfolio. I don't have any shares in my dividend growth portfolio for obvious reasons. We see that they only grow about 2% per year, but they do grow. So I am investing in Verizon not for its growth, but for its current income. And many of you will know that I've retired and I'm looking to build a yield portfolio that'll provide current income for me. Verizon fits that bill. It is a 4.8% yield. I believe it has a pretty strong balance sheet. They have positioned themselves well with these 5G licenses. They bought more than any of the other companies. They are now in the process of building that out, so they will be spending a little additional capital more than in the past. However, they have strong cash flows that will not only cover the dividend, but also cover these additional capital expenses over the next few years. So for me, I am strongly in favor of Verizon in a yield portfolio. If you are, just starting out in your retirement journey, probably not a great stock for you because it produces a lot of yield, but not a lot of growth. I mean, that's my personal opinion. Obviously, I'm not a financial advisor, but if you're looking to grow your portfolio over time, you're looking for dividends who are growing at a pretty fast pace, and Verizon doesn't meet that. However, they have a current yield that is very, very attractive. For people like me, that's a great stock to own in my yield portfolio. So let me address the question, why Verizon versus AT&T? I haven't done an in-depth analysis like this on AT&T, but I will tell you why I haven't done that. When I think about Verizon versus AT&T, there's a couple of things that kind of set Verizon apart from me. One is that they have strategic focus. They are focused on their core competency, which is the mobile network. What I look at in AT&T is a bunch of confusion, actually. I see them seeking out media assets for growth. I see them not really wanting to spin those off, but they had to try and unlock some shareholder value. I have seen AT&T miscommunicate strategic decisions, whether the spinoff of Warner Brothers Discovery was going to be a spinoff or a split. So there was just a lot of confusion, a lot of communication confusion, and I'm not really sure that I see strategic focus from AT&T. So that's point number one. Point number two is that I see strategic objective execution in Verizon. Verizon has a very clear model on where their growth is coming from, and they are seeking it out and they're accomplishing that. AT&T, it's a bit confused. It's a bit distracted, maybe not confused, but distracted with its spinoff of Warner Brothers Discovery. So I think that's another reason that I stay away from AT&T. And for my friends who are younger and newer in this retirement growth portfolio, I think you should look at either Verizon or AT&T from a dividend yield perspective, not a dividend growth perspective. I don't expect either of them to grow their dividends dramatically. So if you're looking for dividend growth, I don't think AT&T or Verizon are going to get that for you. So with AT&T, you are in the middle of a spinoff. It's kind of sexy. It's kind of exciting. You don't really know where it's going to go. You think there could be some potential there. I would look through all of that. I would certainly be interested in AT&T if the board had taken a similar decision to the board of Verizon in hiring a new CEO to come in, as they did with Hans Vestberg at Verizon, to create strategic focus in the company. I don't think Stanky has that capability. I think he wants to grow the company, and I don't think he really cares what industry he goes to get that growth. So that's my personal opinion. You can make whatever decisions you want regarding AT&T versus Verizon, but those are my thoughts. So if you're looking for a high yield dividend contender, look at Verizon and give them some serious consideration. At least in the future, as far as I can see, Verizon will always have a place in my yield portfolio. It creates a 4.8% yield for me, while potentially having growth in the future, although I'll believe that growth when I see it. So with that, thanks for joining, and I will see you on the next video.